How do you make money on the stock market? Many new investors dream of making millions on the stock market by trading stocks. How is this done correctly? Are there any pitfalls in this method of money making? The stock market has seen fortunes won and lost in a single day. Such wild swings in fortunes make the stock market one of the most mysterious markets. One of the questions that many new investors have is how exactly does someone make money on the stock market? There are two simple ways to make money. One is based around the idea of selling, and the other is based on not selling. How do you know which stocks to target? Well, that's determined by the primary research strategies of technical analysis and fundamental analysis. What is a stock or share? A stock or share represents a portion of ownership for the company that issued the share. What does that portion of ownership mean? It means that an investor can vote in the company's annual stockholders meeting. Each stock represents a single vote that the investor is entitled to a portion of the profits that the company made in the previous quarter, usually distributed as a dividend check. Where are they sold? Stocks are listed on a stock exchange and then are sold to investors through either a traditional brokerage firm or, like in recent years, many investors are purchasing their shares through a brokerage website like E-Trader or Robinhood. These exchanges are where all stocks are listed around the world, with some of the most famous stock exchanges being the New York Stock Exchange, London Stock Exchange, and the Shanghai Stock Exchange. What determines the price of a single share? The amount of a stock is determined by the price that someone is willing to pay for it. Once a sale has been completed, the stock will generate a new amount based upon the last sales price. If an investor was willing to pay more for a share than the market price, then the market price will go up. Inversely, if no investor is willing to pay the market price, but was willing to pay a little less, then the new market price will be lower and lower, till an investor is willing to pay more. While this system may sound straightforward when only talking about a single share, but when a stock can have hundreds of transactions in an hour, the situation becomes a lot more complicated. It's this complexity that gives rise to the volatility in the stock market, making it seem that no stock has a stable market price. Because of all the transactions going on, the more popular the stock, the more likely it is to experience volatility. Who ensures that the stock's price is fair and not maliciously manipulated? With thousands and thousands of transactions occurring daily, some of which happen within seconds, criminal activity is not only possible, but very likely. What are some examples of crimes or securities frauds that occur? One of the first two crimes is insider trading. What would you do if you had a piece of information that was not available to the general public? For example, if you got the word that a CEO was getting ready to step down. If you acted upon this information, then you would have committed securities fraud by using insider trading. This is when an investor uses the knowledge that's not generally known as leverage to either buying or selling a stock. The other common crime is known as the pump and dump scam. Say you've purchased a stock that the price is not moving in the way that you want. Could you convince others to buy the same stock, hence driving the price up, only for you to sell the stock? Well, no, because that is securities fraud, and it's commonly known as a pump and dump. What happens is that after a certain point, no new investors wishes to purchase the stock, causing the price to plateau. Eventually, the stock's price will decrease as more and more investors sell off a non-profitable stock. This may sound a lot like a Ponzi scheme, because both a Ponzi scheme and pump and dump scams follow the same idea of getting newer and newer investors to purchase a faulty product. Before we move on, I'd like to thank Skillshare for sponsoring today's video. Skillshare is a platform where you can access thousands of information-packed courses, literally. You can get classes on topics such as finance, photography, drawing, and so much more. Whether you're looking to fend off boredom, focus on self-care through creativity, or join a similarly creative community, Skillshare is the place to keep you learning. One course that I really liked in particular is Bookkeeping for Freelancers: How to Handle Your Finances by Emily Simcox. In the course, Emily will guide you step by step through managing your business expenditure and revenue. Whether you're a freelancer getting ready to invoice your first client, or a small business owner looking to organize your business's spending and expenses, you'll gain an arsenal of tools to help you streamline your finances and optimize your bookkeeping. After taking this class, you'll be better positioned to make decisions with confidence, grow your business, and focus on the work that matters. So, if this is something that excites you, then you need to check it out. So, the first 1,000 people to use the link in my description will get a free trial of Skillshare Premium membership. And after that, it's only around $10 a month. Now, who protects the average investors against criminals and fraudsters? Well, in America, the Securities Exchange Commission, SEC, And in the United Kingdom, there's the Financial Conduct Authority, FCA. Both of these organizations are meant to protect the average investor by making sure that securities fraud is caught as soon as possible. There are also the organizations that will determine whether or not a company will be able to list through the IPO process. This means that financial regulators are the organizations that ensure all new public corporation is on the up and up. They're making money while selling shares. What does it mean to buy low and sell high? The way that most investors make money on the stock market is that they purchase a stock when its price is low. Then, when the stock's price has reached a certain level, the investor will sell the share and make a profit minus the transaction fee, if applicable. What are the differences between day trading and long-term? And what is day trading? A day trader is an investor that generally holds a stock for a short period. This means that some day traders will purchase stock in the morning, only to sell it in the afternoon. It must be noted that due to the volatility in the stock market, many financial regulators have day traders listed as a specific class of investors. This means that many brokerage firms and websites have a limit on the number of day trader-like transactions that an investor requests in a single day. This is referred to as a pattern day trader. To be classified as a day trader, an investor must keep $25,000 in their account. Before we continue, I'd like to know, are you getting any value so far? If you are, kindly like this video. And if you're new, welcome, and go ahead and click subscribe. Done? Good. Let's move on. What is the long term? While day traders can make small, quick profits that add up over time, if an investor wants to make a lot off a single sale, then the investor will have to find stocks that are low now, only to be higher at a specific date. This can happen when an investor purchases a stock on its IPO day, or when an investor believes that a stock is underpriced. The idea behind this kind of investment is not to make money tomorrow or the next day, but months or maybe years from now. They're making money while short-selling shares, or the fastest way to build wealth and lose money. What is short selling? When an investor short sells a stock, they're creating a contract with their broker that they will borrow X number of shares to sell. Then at a specified time, the investor will repurchase the stock to give back to their broker. Why can it make a lot of money? Imagine that you're short selling stock A when it's at $100 per share. So, you would have made $100 times the number of shares. When the designated time comes around, the stock's price has dropped to $95 per share. You will repurchase these shares with the money you made, selling them in the first place. But now there's a surplus, and the stock's price has gone down. You keep the surplus as profit and give the shares back to the broker. So when an investor is short selling a stock, there's virtually no limit to the amount of profit that they can earn. But the inverse is also true. If you can make a lot of money, it's also possible to lose a lot of money. How risky is short selling? When the market price goes down, then the investor will make money. But what happens if the market price increases? Then the investor will have to pay the difference between the sell price and the buy price. If a stock's price is increased drastically, then it's possible that an investor's entire capital can be wiped out. They're making money while not selling shares. How do investors make money from dividends? Some investors want to have a steadier stream of profits. If an investor wants frequent and regular payments, they'll look into dividends. Dividends are regular payment of a sum of money from either profits or cash reserves to their stockholders. Dividend payments have an effect of temporarily raising the market price of a stock. Though they only affect the current market price until the cutoff date, dividends can drive up the value of a stock. If a company consistently issues extensive dividend checks, then investors are more likely to purchase their shares. How to get more shares while not spending any money? When shares are split, a unique way to gain more shares is when the corporation decides to split its shares. This means that if you own one stock, then you would own 2 shares. Though you'll have more shares, the total amount will stay the same. This is achieved by having the market price, since there are now twice as many shares in existence. A company will do this if they perceive that their market price is too high, so they can lower the cost per share with little negative factors by splitting the stock. What happens if someone offers me money for my shares? A buyout from another corporation. Let's say that Corporation A wants to take over Corporation B. How do they do it? Well, the basic strategy is to purchase a majority of Corporation B stocks and force a takeover. During this time, Corporation A will make a general offer to the shareholders of Corporation B. It's then up to the shareholders of Corporation B to decide if they wish to accept the offer. This can sometimes be done by a group of investors that want to reprivatize the company. This situation is very much like a hostile takeover, but instead of another corporation. The buyout offer comes from internal sources, with already established shareholders spearheading the movement. What are the different techniques to make money on the stock market? There are 2 different techniques that investors use to find the correct stocks. These techniques are technical analysis and fundamental analysis. What is technical analysis trading? The essence of technical analysis technique is to use past data to predict future behavior. The idea behind this technique is that the past will repeat itself, or to be more exact, that stocks will inevitably show a trend. Once an investor recognizes the pattern, they then can make business decisions based upon those trends. What is fundamental analysis trading? Unlike the technical analysis technique, which focuses on the factors around the buying and selling of a stock, the fundamental analysis technique focuses on the intrinsic value of stock. What investors mean by inherent value is a combination of factors. These can include but are not limited to the current CEO, the dividend check, or potential intellectual property. It's based upon these factors that investors decide if a stock's going to increase in value or decrease in value. So, what have we learned about making money on the stock market? That the stock market can make an investor a fortune, or if they're unwise in their investments, they can lose wealth. Though there are just a few ways to make money on the stock market, the idea behind selling stocks sounds very simple, but there are things to consider. Well folks, thank you so much for watching, and if you found this video helpful, do show some appreciation by giving this video a thumbs up, and subscribe if you're new. With that said, have a great day you guys, and I'll see you in the next one.